Hi there. In this second video, I'll be demonstrating to you how to prepare Part C and D. In Part C, you're asked to explain the basis for valuing inventory using an appropriate accounting theory. Whenever we talk about valuation of the inventory, it is always the choosing of whether the cost or the net realizable value, and a business must always pick the lower one. So if you look at the cost of our inventory, it is actually 14,000 at the end of the month, or at the end of the financial year on 28th of February. And here, the question also tells you that on 28th February 2016, our net realizable value is only 11,880. And this is much lower than the cost here that we have prepared. So a business, or rather in this case the business, will need to choose 11,880. What if the cost is actually lower than the net realizable value? Say that it becomes 10,000 our cost, whereas net realizable value is 11,880. We will actually have to choose the cost, because suppose the cost is only 10,000 and that's the lower amount. So to answer the question, this is a 2-mark question, so you must always state the accounting theory as asked by the question. So we're gonna just type this out. We will use the prudence concept, because the prudence concept states that a business must not overstate its assets and revenue. So we must always recognize losses whenever they are deemed to be occurring. So according to the prudence concept, we are going to answer the first part here, explain the basis for evaluating inventory. Inventory is valued at cost or net realizable value, whichever is lower. This is to avoid overstating the assets. So the prudence concept is 1 mark, whereas the valuation of inventory here is the other mark. Okay, we don't want to overstate our assets, because if you overstate the assets for this financial year, the following year you will have a higher cost of sales. And with higher cost of sales, you would naturally have lower gross profit, and this might lead to a lower profit for the year. So always report your inventory at the lower value. Next, in Part D, they ask you to analyze the effects of the adjustments in C on the profit for the period on 28th February 2016. Now, you have to assume that the business actually did an adjustment, because we no longer can record the inventory at 14,000. We need to record it at 11,880. So how much losses did we recognize here? In this case, the impairment loss on inventory is actually worth as much as 14,000 minus 11,880, giving us 2,120. Alright, so here, this is the losses that we have, and this loss will actually appear in the profit and loss portion of the income statement. So since the business will recognize this loss, naturally our profit will decrease by 2,120. Because with increase in losses, we have increase in expense. Increase in expense has got an indirect relationship with the profit for the year. So our profit will actually go down, and decrease by 2120. So this is for part C and D. That's all.